Welcome back to the final hour. It is 3 p.m. Eastern Time on the 9th of October. Pretty interesting day, a bit of a directional day, melt up in the U.S. markets. We'll take a look at everything. We had the S&P up about 0.5%. We really didn't have any gaps to work with today. It was just right out of the gates. A little bit of calm. Ended up grabbing a winner in SPX, and then I had a loser in SPX. Ended up flipping my SPY direction. I was looking at a long put based on a gamma squeeze index, that was targeting a 567 strike, and kind of stacked up to the downside. Price didn't cooperate today, so I bailed and took a small loss. I ended up losing about $1.80 on that. And then on the upside, I actually am currently sitting with a long SPY at 580, looking to see if my 579, 580 strike prices will get hit. So I just have a long call on the SPY now for Friday expiration. We have CPI data coming out tomorrow. That's going to be the most important thing. We essentially just had a little bit of a move and a melt up prior to that. The expectation for CPI tomorrow is 2.3% year over year. We will see what there's a lot to digest here. We have to have, so we have core CPI, and we have month over month, and we have year over year. Okay, then we have CPI month over month and year over year. And then we have PPI, which is going to come out on Friday for the same thing. So PPI month over month and year over year. So this is Thursday at 8:30 a.m. Eastern Time. Get up there. Thursday, 8:30 a.m. And then Friday, 8:30 a.m. is PPI. So the trend, let's go to the calendar for a moment here. Hey, Gary, good afternoon, man. So the trend is this. If we take a look at, we also have unemployment claims tomorrow for the U.S., forecasted for 231. Initial jobless claims, unemployment claims, continuing jobless claims, all these things have been pretty steady in the U.S., stable since July when the market got all scared with the SOM rule activating. Here we have CPI year over year, month over month, and core CPI month over month. I do want to see what this all looks like tomorrow when a market hits. Now, this will be 8:30 a.m. news. Pre-market, of course, we're looking for gaps to see if it's good or bad, how the market's going to react to it. What I'd shown here earlier today, not unemployment claims. Let me see how far back can I go here. I mean, if this puts a couple things in perspective. So unemployment claims during COVID, yeah, that was scary. Historically, if we go way, way, way back, how far back can I go here? Let me see if I can go all the way back here. There we go. So unemployment claims, 2007, 2008, 2009, things got pretty rough with the great financial crisis. We're looking at 500,000 to 600,000 every print, and then we started to steady the ship back around 2012 and 13. Now we are talking about historically low. I mean, look at this thing, around 200,000. I mean, we are by historical standards pretty darn low. So unless this is going to be giving us dramatically higher unemployment claims like 250, 275, 300 plus. I mean, we've got to see essentially the histogram start to trend higher, right? If it's trending higher, there's cause for concern. Otherwise, we just have steady job, unemployment claims around 200,000 per month. It's actually per week, but anyway, we'll see what that print is if it's a surprise. Otherwise, it's been pretty stable. But I want to go into the graph here for CPI year over year, because if we look at the trend since our peak here in summer of 2022, inflation, where the Fed was very restrictive and not budging on the rate cut cycle, all of that was sticky inflation. So we were pretty much dead sideways between 2.9, 3.3, 2.9, 3.3. For a year, we stayed right around that 3% handle. Well, then we went from, this is let me see if I can grab this one here. So that was a print of around 3.2, 3.4, 3.2, 2.9, 2.5. So just over the last 1, 2, 3, 4 prints, we've actually seen this trend break lower. Okay, so tomorrow, forecasting a 2.3, do we actually print a 2.3? And this continues to support the trend that we are going down in inflation. I also think that oil has made a big enough turn. This is probably the stickiest point of inflation right now. If we're looking at oil prices, okay, oil ripped up by about 17 or 18% from these lows. That was up 18%, and oil has pulled back around 8.7%. So we're still not necessarily breaking any highs in oil. We don't really have much of this squeeze that could, I mean, we could still have a squeeze. I'm not saying that we can't. But to me, if oil stays below $80, if oil stays below $80, I think inflation will continue to stay calm. Okay. If it doesn't, and we get above $80, inflation is going to be a problem. It will be a problem. Now, the market may not react to inflation right away, but the market is going to react to it at some point. And maybe it's by the end of the year, maybe it's early 2025, I don't know. But for me, the real ugly point is if we get convincingly above $80, I think inflation is going to be a problem, and I think the Fed is going to be way less dovish than what the market's anticipating right now. I did take a look at the Fed Watch tool in a previous session today. So CME Watch tool. According to the probabilities right now, the Fed is still likely going to cut rates by 25 basis points in November. In fact, this actually jumped up by about 6 or 7% in the last 30 to 45 minutes. This was around 75, 76%. Now it's up 81%. So the market's still anticipating a high probability that the Fed will cut again in November, and then looking for the Fed to cut again in December. Now, is that enough? I mean, maybe that's it. Maybe the market's anticipating all these additional cuts all through 2025 and the Fed doesn't deliver, right? What happens if the Fed doesn't cut all through 2025? And the reason I say that is because what the Fed is likely trying to get towards is the 2% yield, which has skyrocketed by about 50 basis points in the last month. So here's the 2-year yield that was as high as 5.25%, which, no surprise, was right around the official Fed cash rate. So 5.25% right here on the 2-year, and then the 2-year has dropped. Okay, now the Fed has cut rates down to 4.75. That's where we're currently sitting. Okay, now this seeing the move to the upside at 4% right now, I wonder if the Fed cuts another 25 basis points, okay, for November, and then cuts another 25 basis points for December, where does that put us? That brings us down to 4.25. Okay, 4.25. Now that gets us pretty much in line with the 2-year if it stays where it is right now, around 4%. So unless this 2-year is going to turn back south, which I don't think that it is, because the bond market especially, was front running the rate cut that was coming in September. The bond market got all excited. We had a nice trend in all the bonds. So you look at your yields, they were all dropping. You look at your bond prices, they're all rallying. And literally, you couldn't have asked for a more obvious bottom. Buy the rumor, sell the news. The yields start to rip post-Fed, and the bond market started to drop post-Fed. And so I don't think that this is a bad thing, because the bond market going down is actually a sign of strength in the U.S. economy, right? So you have to remember that the bond market is basically your safe haven. It's supposed to be. It's not supposed to correlate with the stock market. And so if stocks are higher, the bond market is usually flat to lower. And the money that you make in the bond market is not necessarily from price appreciation, but more so from holding to maturity, because it's U.S. debt. It's backed by the U.S. government. It's the greatest debt in the land. The bond auctions continue to be pretty stable. I saw that today in financialjuice.com, which is a good thing. Like foreign investment is at like record highs right now, which is probably a good thing. So I suppose, I mean, the bond market remains pretty healthy and liquid, and there's no sign of slowing for the additional short-term auctions that the U.S. is offering. But I don't know, stock market keeps grinding higher. So take a look at our S&P today. We had a fresh breakout. I believe this is the 44th high of the year. 44th all-time high of the year. I think that 2024 has been one of the best election years ever on record. If it's not, we have maybe one better back in the 90s. But this is one of the best years on record. All-time highs, it's up there. It's like top 10 maybe of all time, maybe top 15 of all time, which is pretty impressive. And we just broke out of this recent range. Now, tomorrow's data is going to be really important in my opinion. And the reason why is if the market sees that the trend is still pushing lower and we do hit that 2.3%, is that enough to get the market to get all excited for another jump higher? Okay, now this market is almost behaving like the election doesn't matter. I mean, I'm noticing that the volatility index, I had some VIX term structure up here. All this means is the market's expecting a lot more volatility in the short term than longer. So if you go out, this is showing the VIX term structure, which is showing a bit of backwardation, which means that the short-term volatility is at a higher premium than the longer-term volatility. And so what you want to see this VIX term structure do is you want to see this look like this. You want to see this, where your short-term volatility is cheaper than your long-term volatility that's more uncertain, right? That would be contango. So right now, this is still implying that there's higher volatility moving into the election. And then once we get through the election, things really just get calm. Now, this is an interesting number because we're not at 15, we're not at 12, we're not at 13, we're not at crazy lows. There's still a slightly higher volatility in the market, right? But it's not outlandish. We're not seeing the VIX at 25 or 30. We're seeing the VIX in the teens. And historically, the average is around 17. We've just had really low volatility early this year. Okay. All right. So anyway, SPY's at all-time highs. NASDAQ is trying to get back up to this high we saw back in September. This is September 26th high. And then our official all-time high in the NASDAQ is back in July when the market dropped really, really aggressively. That was a lot of things playing into this. But I do wonder if this low and this trend line that I have drawn right here, this thicker line, if this line does not break, I mean, I understand we could go sideways. Okay, we could go sideways on the Qs, and that's understandable. But if we are sideways and we don't necessarily roll over to the downside, this is still just a pause to see if the market can justify going higher, right? What I think would be interesting for the NASDAQ would be, can the NASDAQ actually get to all-time highs and get to this all-time high before the election? Because if it is the case, I do wonder if this is just a pure broad market melt up for everything. So the Russell could be at high, the Russell could make a run to the all-time highs, which it hasn't seen since 2022. Dow could notch another all-time high. The NASDAQ could come after the all-time highs. The SPY, of course, would be making all-time highs. I do wonder if there's room. Now, if you take a look at my charts here, when I zoom out, this is the technical picture that I have. We are making higher highs. We are making higher lows. This market still has room to get up into this space here. So could we see 525, 530, or 540 in the Qs? Yeah. Could we see 600 plus in the SPY? Yeah. Unless price does something to prove otherwise, I'm looking to see if this market will just continue to melt up. Now, data will be important, but if the market can get through, think about tomorrow and Friday. If we get through CPI news, which is another trend lower, and the market's reassured once again that inflation is trending lower, employment stable in the U.S., the economy is strong, the Fed doesn't have to get crazy and cut, be super dovish as monetary policy to save the day. This could be a good thing to still have a cycle expansion. And what I've been talking about this the last couple of weeks. So the thought of this market right now is that this is considered a late cycle expansion. Okay. Now, I'd almost be willing to say that this could be a late cycle extension as opposed to an expansion, because we're just continuing with what we've already had. Just what got us here is kind of keeping us here, and things have, continue to see good stabilization in the markets and good fundamental data, and the market is pretty, positive with sentiment, right? So this could be a late cycle extension. But also, I wonder if this could be a reset to a mid-cycle. So the expansion is still alive and well. Now, I don't know the answer here, but if we have a late cycle expansion or a late cycle extension, this is on borrowed time. All right, which means that we would run and extend higher and extend higher and extend higher, and eventually that starts to roll over, and we will eventually get a correction. We will eventually get a recession. We will eventually get a lot of things, right? It's so right now ingrained that it's like we should never have a down year. We should never have a down day. We should never have a down month or down week. It's amazing to see that this market only wants to grind higher, but believe me, when price starts to roll over, it will be ugly to the downside if and when it does. So a late cycle move is on borrowed time. But if there's a way to get all of these elements to then reset the cycle and get us back into where, rather than being late cycle, we're back to like mid to early late cycle, something like that, then we might be able to extend this thing even farther, even higher until we hit some levels that nobody thought we would hit. Now, I still look at this technically and I think, man, this is a spot that I would be looking for a correction in a big way. And I truly would, because if we stretch that high, and it doesn't have to be very difficult, because if I look at a 200 moving average, for example, and this market is going to stay away from it, 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 and we have this big distance between price and the 200 EMA, there's likely going to be a reversion that happens. And that's true on every asset. That's true on gold. It's true on Bitcoin. It's true on the NASDAQ, the SPY, the Dow. It doesn't matter what it is. If it gets too far away from these, dynamic levels, it's going to pull back. And you can go back and test this on any chart you look at. You will see that, oh my gosh, it didn't hit this for so long. Look at, like right here, it stretches pretty far away from it. Look at that percentage. Right here, it stretches pretty far away from it. Look at the percentage. Look at the time that it took from one test of the 200 EMA to the second. Okay, so percentage-wise, I mean, I have a ballpark. This is going back into 2020. Let me check and see where this high was right here. So this high pulling back, I mean, that's 22% overextended. And you can see that the market at about 20% made an attempt. It didn't find it, but it made an attempt to at least stall. And I'm wondering, same thing here. Maybe it's around 20%. So is that the case? Yeah, maybe. Let's go back a little bit further. Okay, how about another, kind of overstretch? How about right here? So from this level to the 200 EMA is around 13%. Okay. How about this one? Probably about the same, 12 to 13%. This high here, around 9 or 10%. So that's not crazy extreme. Let's find a couple more and then I'll move on. How about to the downside? We go really far away from this low to high. Now we're to, oh my gosh. Hang on a second. Let me do that lower. Let's go from here. About 38%. So if we get like 20 to 30 plus percent extended or away from this 200 moving average on the NASDAQ, I would be looking for a top to form, or I'd be looking for some type of correction to happen. Okay. I mean, when we had a crash here during COVID, I think I tested that one, right? That was around 15%. When we had this recent push here, we were in the teens. I think I measured those already, up about 12 to 13%. So the move that we had back in August, let's see what that one was a percentage. So August, we were about 15, about 15%, and we snapped back to it. So I would say to the extreme side, 20% or higher is be cautious. I will be cautious. And I'll look at the same thing. Like it's not going to be some tried and true number for all the different asset classes, but go back in history and see how far away did price get from the 200 moving average, and then we likely revert back to it. Same thing on the S&P, same thing on the Dow, same thing on the Russell, same thing on gold, same thing on Bitcoin, same thing on Nvidia. I'm actually looking at Nvidia right now, and Nvidia's back up to these recent highs, not all-time highs yet, but Nvidia, after we had this move here, look at how far Nvidia stretched away. Nvidia from this high has been about 40 plus percent away from the 200 moving average. Now, it's not a surprise that as it extended that high, that we are starting to correct. Now, I don't know what this looks like, but if we come back to this high in Nvidia, is this going to be a slow grind to the upside, NVIDIA hits the top and then fails. If NVIDIA gives us like a double top, for example, does this thing come all the way back down? Possibly. And that 200 EMA is sitting right there. So that could be a really easy measurement for us to, not be buying into highs and not be buying into overstretched markets and just be bracing for some type of pullback and get ready to hopefully scoop up some nice discounts and dips. All right. So just a good little lesson there. I did pull up this chart earlier as well. I'm in some AT&T right now. They have earnings coming up in a couple of weeks. I own some shares. I am trying to trade this higher without necessarily getting in the way and covering it. If AT&T continues to go higher, what I'm looking for here on the right-hand side is a volume profile that we're right now at a bit of a sticky level, right around this $22 handle. But if we can actually make a run for 22 plus, there's not much stopping this until we get back into this inefficiency and back into this volume profile, which is right around $26 or $27. So for me, with the position that I do have, because this was a value play for me around the $15 handle, I'm trying to basically own the shares from 15, get them called away at 25, walk away with $10 a share. I have done some covered calls over the last couple of years with this, and I've lowered my cost basis a decent amount. So maybe my upside, instead of going 15 to 25, maybe I've lowered my cost basis by, let's say $2 to $3. And so I essentially increase my gains by 20 to 30% just by using some options on my core position. But I'm looking to see. Hoping that earnings are okay. The fair value for AT&T is actually, like, it almost seems like it's far fetched. It's $80 according to the discount cash flow model. $80 is the fair market value. Which, am I going to hold this to $80? Probably not. But would I love to hold it to 30? Yeah, I'd love to hold it to 30. I think that'd be an awesome trade. So if we can get a nice little bump up here towards $29 to $30, I would be pretty happy to take some profit on AT&T. But that's a boring stock. I had a little pop today on Pfizer. Pfizer's trading at 30.08. I'm looking for Pfizer to get it called away around 29.50 in the next couple of weeks. I was considering a roll on my diagonal spread. I was going to roll out the sell call out another week and try to collect a little bit more premium. But I don't want to get too cute, too fancy with it. I think the earnings, let me see when earnings are on Pfizer. Earnings are the 29th. So I was contemplating going out one more week, rolling it out to the 25th and keeping it the same strike price. I'm seeing that's trading for like 14 to 15 cents credit. If I do that on all of my accounts, that's going to help me generate an extra $1,100 of profit. And it still gets called away at $29.50, which is okay. So I think I might do that. I just want to get, I don't know. I'm thinking about it. We're trading, 50, 58 cents higher than my sell call right now. And this can get expired next week, get it called away on the 18th. I don't know. The reason I'm even hesitating is because my long call expires in June, and I'm not going to take assignment or exercise my long call, which is a $25 call. I'm not going to take on the shares simply because if I own the shares, that's $25,000 in capital, in cash, that I have to allocate, and I don't want to do that. So I'm using the option. I'm using the leverage. I'm up about $21,000 right now on Pfizer, and $21,000 is great. $22,000 is better, but I don't know if it's worth it to go out the week prior to expiration or prior to earnings. So to be determined, but I'll kick this one around. I'll mull this over for the night. A couple other things I want to talk about today. This is what the day looked like. If anybody's with me this morning, I did show some gamma levels on my SPY chart. You can see that the market did change quite a bit in real time. So the 567 histogram that was there today, it is nowhere to be found. So this market, as soon as we started to melt up, this all disappeared and all these gamma squeeze levels to the upside started to fill in. So the nice thing for today is this level at 580 is now about 100 current net higher than it was earlier today. I saw this around 400, then 440, then 450. Now it's up over 542. My hope for this trade tomorrow is that the CPI data is positive enough to get the market to gap up, and we can start hitting this like 579 to 580 level. And I have it's a SPY $1.41 debit. Okay, I bought the 580 call for $1.40. Now, if tomorrow morning this thing opens up at 579 or 580, that's probably going to be trading for $2 and change. I'd like to close this out for about $2.50 or better. If it trades up over $3, that's fine too. So it really depends on how aggressive this gap is to the upside. It was a pretty inexpensive long call, but if price is up to 579 or 580, I'm happy taking profit at 250 or better. Okay. Yep. Yeah. Well, Mark, you have it. If you want it, you just got to pay for it, dude. I pay for it. So the gamma squeeze index is a part of Dynamic Trends. It's in my Discord channel with an affiliate link. If you want to subscribe to it, and it's part of your traders package, which I've used it for years. It helps me with direction. What I did for traders today is I was really active in closing out losers. It sucked. Like I closed out the SPYs for $1 loss or like 90-cent loss. And then I closed out another one for, I said it in my Discord. It's like I took losses today. I had one winner on the SPX. Let me go to the options chat here. So for today, I had, let's see here, a $40 win on the SPX, a $310 loss on the SPX, a $180 loss on the SPY, a $62 loss on the SPY. And then I'm looking to see if I can, grab maybe $100 and $150 tomorrow on the SPY for a positive. And that's fine. I'll make up a little bit. I'll erase basically the SPY loss by a couple of bucks. And then I'll take another SPX trade tomorrow. Portfolio as a whole was up today, up about $6,000. We're coming into the last 30 minutes or so of trading. So it could be worse. I was up about 12K at one point, down about, $6,000, $7,000, $8,000. I mean, it's fine, but the market melting up, that's fine. I'm just watching. So, but it's just a trade. Yep. Thinkorswim. So you don't have to have the gamma squeeze for Thinkorswim. I know that the team at Dynamic Trends, they do have Thinkorswim in the works, and they're trying to put it in the Thinkorswim platform. But I don't have this attached to a broker. This could be attached to TradeStation. This could be attached to Tradier right now. But the reason I use Quote Media is because that's the same thing. Like, I don't know if anybody's traded FOREX, but the FOREX market, when I test strategies, there's a price feed that's kind of universally accepted, and it's Dukas copy, and that's for like back testing. That's tick data. And so Quote Media is kind of that same type of thing. This is a like universal data feed that a lot of brokers tap into. And so for me, this gives me a good idea of what the general market is doing, and it's not specific to Thinkorswim or Tradier or TradeStation, which those gamma levels, by the way, are going to be slightly different. So Mark, for example, if you got Dynamic Trends and you put it in Thinkorswim, your gamma squeeze levels are going to be slightly different than mine, because mine's Quote Media and yours is Thinkorswim. Right now, they should be communicating roughly the same thing, but you never, because all these brokers are they're in the clearinghouse business, right? So when order flows come in, this broker, they're all working together to clear these orders, and so they should be roughly showing the same thing. But they're going to be different with the current net. They're going to be different with the actual gamma levels. How quick one moves over the other, I don't know. But anyway, you can use it with, correct. You don't have to have a broker. Like, I don't trade out of this platform. Okay, I can connect this to my broker, but I don't. I trade right on my Tasty Trade account or my Schwab platform or my Thinkorswim. But this is Quote Media. That's the real tick data that I have. Make sense? Yeah. So you don't have to have a broker connection with this. Okay. All right. Okay, so that's where we're at for tomorrow. I'm hoping that we have, since I got the long call in, I might as well see it hit 580. And if it does, awesome. Let's go to the SPY. The one thing that's interesting on the SPY, since we're sitting here at all-time highs, is there's not really a lot of volume profile to go off of, right? So, the sticky levels are already to the downside. Now, this doesn't mean like, oh my gosh, the SPY is going to come back to 450. It doesn't mean that at all. It just means that at some point when this market does make a correction, there's going to be a lot more activity in here that we're going to see this market try to gravitate back towards. But like I said, I don't want to make this any more complicated than it already is. Okay, the market is showing us signs that it is trying to go higher and higher and higher. The only hesitation that I will have is if this market literally tomorrow and Friday puts a nasty red candle in. Because if it does that, a nasty red candle means that, okay, this was a fake out. And this market's still going to be choppy and stuck and ugly until we get through October and maybe into the election. But if this market doesn't care about anything and it's just going higher and it just stays here and it goes higher and it stays here, goes higher and it stays here. And then we get through the election, the market's like, yippee skippy, no more drama. This market can take off, and this is just priming itself for more upside. So until price proves it wants to go down, I'm not doing anything outside of having. I've got some hedges on here. Like I've got hedges that are, out of the money on MES and out of the money on ES and out of the money on MNQ and NQ. So I've got long calls up here on the futures market, and I've got long puts down here in the futures market. And if we get to these levels faster, then I'll close out these and I'll take profit here and I'll offset it, and I'll probably end up making, I don't know, maybe $3,000 per account. So maybe like 25, 30 grand. And I can still take a loss on this account. That's okay. Or I'm sorry, on the put side. But I'm basically like, yeah, I'll let the market do what it wants to do. My portfolio is tilted bullish. I will maintain this posture unless price suggests it's doing something different. So if this price doesn't want to snap lower, it doesn't want to scare the pants off everybody, then this is a melt up that doesn't want to stop. And I think it's surprising that we've gotten through September with really no hiccups, that so far in October with earnings season right on the cusp. In the next couple of weeks is going to get bigger into earnings season. So this week's financials, next week is still financials, but Thursday next week is Netflix. So we're going to start sprinkling in some bigger stocks here. We're going to have Mag 7. This is important stuff. We're going to see if the broader market is still healthy and bullish. What's the consensus? So earnings season could still kick this market into high gear. The election could be a non-event and the market doesn't care. So are we going to go higher? It seems like it right now. Same thing on the Qs. If the Qs want to break and go and break and go and break and go, off we go, right? So that's it. Okay, the Dow, this one's a little bit more indecisive. Look at the Dow today. I mean, heck, this one's trying to get to all-time highs. We had a nice close above all this resistance, that little wick that was on the 27th of September. It is, based on my technicals here, we're sitting here at these highs. If the Dow rejects, it's going to be choppy. And this is still what we have to deal with. So it's not done yet. But does the Dow look like it could go higher? Yeah, we could blow this top off and just keep going. And then it gets a little bit wilder and crazier as it's like, okay, well, now where the heck's it going to stop? Nobody knows. So what would I do? Well, I'd look at the Dow and I'd compare it to the 200 EMA, and I'd look to see how far away we are, because right now the Dow hasn't touched this thing in probably over 200 bars. It's around 235 bars. Oops, get rid of that. It's around 235 bars. We're actually at fresh highs on the day right now, the final 30 minutes of trading, by the way. Let me check. I'm going to check on that 580 call for a second, just because. I don't think I'm anywhere near my profit target, but we are making higher highs and we have some gamma squeeze to the upside. Like, freaking go, man. Just melt up. Let's go. Okay. The Dow does blow the high off. We haven't hit this thing in 235 bars. Percentage wise, it is currently sitting around 7.5%. That doesn't seem too extreme. Okay. So if this were to stretch maybe 15%, 20%, I'd look back historically and see how far away has this thing gotten from the 200 moving average, and how high does it get before it stretches back? So there's about 12.5%. And we went sideways for months until we actually got very close to the 200 EMA. So it's not like highs and lows necessarily. It's just a reversion. This, when we had the COVID crash, that was a stretch of, let me do this the other way. That was a stretch of around 30%. And COVID's certainly an extreme. Okay. But if this gets into the teens, like 15, 20%, I'm probably looking at this thing to stall a little bit. Same thing here. Here's a nice little stall. We got stretched away around 14, 15%. So if the Dow is about 15% overextended, if the Qs are 20, 25% overextended, if the S&P is 15 to 20% overextended, that's going to be a symbol to at least, pump the brakes on being super aggressive. If it melts up higher, great. But I would be looking for some type of reversion. But you just never know. Like the seasonality of these, we could absolutely blow the freaking tops off this year, and the pain trade is going to be just more upside. And so I am exhausted. Like I'm exhausted trying to sit here and it's going to be bearish and watch out and be cautious. This market might not care at all. And if it cares, let's let it care, and let's let it prove that it wants to give us the price action to care. Because other than that, it's like, I care. And all I'm doing is I'm playing defense on ghosts right now, because there's no participant in this downside. So I'd rather let this become a reality. And I'm like, okay, Now let's talk, maybe correction, right? So I'll keep the inexpensive hedges. I'm hedged out through the election. Heads out, towards the end of the year to see if this market melts up aggressively. But other than that, it's like I'm sick of calling the top. I'm sick of being super cautious. It's like this market just wants to go up. And if it proves otherwise, then we'll talk about it and we'll make a game plan. But right now we're trading up to fresh highs on the day. This is a good thing. So here's the SPY again, fresh on the day. Let me get back to this chart. And that's CPI news for tomorrow. So here we are making another poke to the highs. So we had a nice little 5-minute close, last little bit of the day. I want to check my call for Friday. So right now, my $1.40 is trading for $1.60. So here's my debit. It's trading for about $1.61 right now. If we get to, I want to see if this is trading at the money tomorrow. So if I go to the SPY tomorrow, an at the money trade should hopefully be trading around $2 to $2.30 perhaps, if it's at the money. So if we get up to 580, that should be trading for like $2, maybe $2.50. And I can close out my trade and I'm pretty happy with that. Right? But that's if we have a gap up towards 579, 580 tomorrow. If we don't, then I will manage risk and, consider if we gap lower. I mean, I don't know if I'm going to sit and hold it. I might just get out of it and bail. But anyway, it just depends on what the gamma squeeze looks like for tomorrow. Right now, it is showing some decent levels. I mean, this has gone up actually a decent amount. This was 510 when we started the session. It's 590 right now. So, I mean, it is growing as we speak. And hopefully this means that there is a magnet to drive price up to that 580 handle. And if there is, let's tag it. That'll be good for us. Earnings estimates declining through 2025. Yeah, it's very possible. I mean, I think there's still going to be solid growth by that. I mean, the big companies are going to continue to do well. You have all these layers, right? So think about this bull market. You have a healthy bull market. You have the top killing it. So you have your top stocks are killing it. And maybe you have the middle to bottom are steady or underperforming. We'll just say steady. They don't have to be great. And then we have like a bit of a rocky bull market. So like a healthy bull market is everything is good. Okay. If you're going to take this one step further and say that let's say we have a sketchy bull market. We have the top stocks are steady. Okay. The middle to bottom are underperforming. That looks a little bit worse, but we were in this environment. We had a very narrow, high concentration, top 7, top 10. That's it. And these markets were still making all-time highs. So I say that like even if it looks a little bit sketchy from the underlines, you also have what about mergers and acquisitions, right? What about buybacks? What about sentiment? Okay, these things can all extend the bull market into these late cycles before they officially rotate out. Okay, and you can also, like we saw this year, is we were at this super narrow concentration and it finally started to broaden out. That's what happened through July. Everyone started to dump Mag 7 and go into other sectors. We had gold leading this year, silver leading this year, utilities leading this year, financials leading this year. It went into other sectors. So it wasn't just Mag 7, tech, consumer services or communication services, and not staples. Discretionary note was like communication services and tech were the two like leading sectors because that's all your Mag 7 stocks, right? But you still have a lot of tools in here to keep the bull market going. Like it just keeps like it's just a little injection of gas to keep it going. Like think about like it's like a jellyfish, I don't know. This just came to mind. Think about the jellyfish as it flaps its little wings, right? The jellyfish is here, and as soon as it flexes and it pushes itself higher, it can then drift higher. So if we have a healthy bull market, this thing's pumping along and just trying to grind. If we have a sketchy bull market, but you still have the top of it, like this could make one more push. These could make one more push, and it just goes longer and longer and longer and longer. And that is why the famous saying is, the markets can remain irrational longer than you can remain solvent. Now that works both ways. So if it's to the upside and you're trying to be bear, 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 you're getting just crushed as this market goes higher. And on the flip side is it goes down, 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 and you're buying dips, and you're just getting smoked. It works both ways. But what we have seen is the market is way more aggressive on, at some point when the bear market ends, we tend to see the markets recover pretty quickly. But it might take 3 months or 6 months or 12 months to get back to those highs. We were in a 2-year drawdown, by the way, from 2020 to 2021's highs to 2022. We were in a 2-year drawdown until we got to all-time highs 2024. A 2-year drawdown. Okay. So it does what it wants. But anyway, I just think there's a lot of extra factors in here that keep this market going. And it's not just turn and, fall like crazy. It doesn't happen that way. So anyway, but to the point of earnings, I do have a couple of metrics here. So if I go price, so here's forward earnings of the price to earnings ratio, and then price to sales. Okay. So forward earnings and price to sales and price to peak. These are things that I want to keep an eye on. So right now, our PE ratio is around, let me zoom in here. We're trading around 20, looks like 27.5 with the peak. Okay, December 2020, before we had a correction happening. This is interesting. The price to earnings on the S&P was up to 38.23 after COVID. That was crazy. And then it came back in a big way, but the stock market didn't really budge. There wasn't much of a pullback in 2021. It was just business as usual. But anyway, if we go back historically, I mean, we are pretty high. I mean, we're not as high as we were back in 2020. We're not as high as we were back in 2002. We're not as high as we were back in 2009. Right? So there's still room for price to earnings to grow, right? There's still room for the PE to get higher in the S&P. Take a look at fudge. That's not what I wanted. I don't want this chart again. Take a look at this. Price to peak earnings and then price to sales. Yeah, let's go price to sales. These two. So let's go price to peak earnings. This one, if we go back in time, okay, we were a little bit higher in 2021 before we had a bear market in 2022, and we were a little bit higher back in 1999, right before we had the dot-com bubble. So price to peak earnings is getting a little bit close. It's not overextended. It's not in crazy, ridiculous valuation territory, but it's getting close to notable levels that have often given the markets a chance to correct, or catalyst to collect or to correct. Does that make sense? Okay. The median PE is around 17 and change. I think it's around 17 or 18 is the historical average. So we're well above that right now. I mean, we're sitting around 28 right now. Okay. If I overquoted that, maybe it's like 20 or 21, but I think it's in the teens. It's like 17 or 18 is historical. This is price to peak earnings, which is different than your typical price to earnings or price to sales. If I go price to sales and go back in time, okay, this one's getting a little bit closer to highs. Last time we peaked out here would have been in 2021, right before a bear market. Last time we were here back in 1999. It's interesting that back here in 1999, it was a bear market, right? But our price to sales was 2.1 versus now it up being closer to 3. It's closer to 3. That's a 33% higher price to sales. Now, does that mean that we could actually stretch and go higher? Yeah, maybe. So it's just a reference point. It doesn't mean that, oh my gosh, it can't go higher. That's impossible. But what it does mean is that our valuations right now means most stocks are priced to perfection. A lot of these gains are being priced in because we're paying some high valuations. We are paying for high valuations. All right. So I do think this is something we need to reference and watch just to see if it actually exceeds what we had back in 2021. because that's my only reference point. I mean, going back to 1947, the only thing I can say, yeah, this was a cause for a bear market, or at least one component of it, was price to sales in November 2021 at 3.01. So do we get above that? Yeah, maybe. Is there a bear market right around the corner? I don't know, but it could be. Okay, and then price to peak earnings. Do we get back to the highs here? Which would be, if I zoom, I don't want to zoom in too much, but let's go to this portion. Yeah, so that peak was around 29.69 in April of 2021. Now, late 2021 was where the market actually topped out in tech, and January 2022 was when the market topped out in the S&P, and then we had a broad bear market. Everything was down in 2022, right? Outside of currency trading, we had a bear market across the board. Bonds were down, stocks are down, every sector was down, and so price to peak earnings, it's getting up there again. So should I keep an eye on this? Yeah, I want to watch this. Okay, last data point, July 2024. Like, I want to see how far out can we go. This is probably a quarterly measurement, which, let me see if I can get this to September. Can I go any later than that? I'm hoping I can get a September reading here. Last data point, July 2024. So I do want to keep an eye on this one, but it's just a reference point. But if we get a little bit higher on the price to earnings, price to peak earnings, price to sales, I'll pay attention. And if I combine that with the distance away from a 200 moving average or stretch away move, all I can do is just, let the price drift, let the price do its thing. Try not to get in the way, try not to get out too early. But there is a point in time which I'm going to be a little bit more protective of my profits. Okay. All right. I see somebody asking about the Swiss crosses. Sure, we'd take a look at the Swiss. So today, the dollar was the clear winner. The New Zealand dollar was the clear loser. The Japanese yen was also down today. That's a big swing. That's about a 160 point move or 160 pip move on the New Zealand dollar. That's a crazy candle. So the RBNZ cut rates by 50 basis points. And this is just a range trade. And it's also been an inefficient range trade. So there's two levels. I mean, I know this trade isn't done yet. I'm not interested in catching nor calling the bottom. But if this goes down to this support level around 5,800 to 5,850, I wouldn't mind taking a stab at this for the upside. And even talking about dollar cost averaging into a 5,850, let's say 5,750 to a 5,650, I wouldn't mind buying this area and then trading this back up into the middle of this range. Just food for thought. Like, if this is just a big range, I could see this market bouncing here. I could see this market bouncing here. So that's my trade. I mean, and again, if I trade small enough, if I trade small in here and price goes my way, I take profit. If I trade small in here and I add some more and I add some more, I take profit where this was support. That's an easy spot. Or if it gets back into this level, then I take profit at the midpoint, because all this downturn has been quite inefficient. And so I'm looking to see if that is a kind of liquidity grab for the market. So I would look at this daily chart and say, we've had inefficient candle, inefficient candle, inefficient candle. And so the more this goes lower, the more extended it gets, the better this looks for a stabilizer and then a move back up into these pockets and inefficiencies. So right now, I don't have anything on the New Zealand dollar outside of waiting. I actually want this to go a little bit lower. I don't know if that's going to be driven by the New Zealand dollar and or the dollar, but if we hit 5,850 or 5,800, I'm probably going to take a stab at this one and try to buy it, and then be willing to dollar cost average into it down to like 57 or 56. Okay, let's go back to Swiss pairs. So Swiss pairs, I'm still bullish on Aussie Swiss. I'm still bullish on CAD Swiss. Let's go Swiss yen. I'm still short right now, upside down a little bit. Euro Swiss, I'm still long Euro Swiss, trying to get back to 1.00. Pound Swiss, I'm still bullish on this one, looking to see if we have a 5-wave move. If this is 1, 2, 3, 4, 5, see if we can get back to like 1,600 or so. Watch that structure. If this is a double bottom, then perhaps we get above the center high and we measure that move up and we get to 120 plus. So I still like this trade. New Zealand Swiss looks the worst right now. And, is it going to test lower lows? Maybe. I don't know. Maybe we test the same level here and it's a little bit higher, a little bit lower, and just gets wider. Okay. Or does it come back down and retest the flash crash lows, and I look at a double bottom, and I still trade the same thing. I'm still going to get positive swap. I don't know if the RBNZ is going to cut any more. Are they done at 50 basis points? I don't know. So if we are going to see support holding, I mean, this is a strong level support. And if we are at 4.75%, and we stay there, and the Swiss remains at 1%, well, there's still a differential. This is positive swap in the Kiwi Swiss. But technically, I mean, it's got to cooperate. And for the Australia dollar and the New Zealand dollar to get stronger, we probably have to see better flows out of China, and we have to see a weaker dollar. Okay. SPY is jumping through. Yep. So we are just poking, highs as we get into the close today. So we have another 8 minutes. And this is also why I didn't take a stab at a late SPX strangle, because there's too much direction late in the day, and this has been a directional day altogether. And so anybody out there that's watching this, if you're in my daily profit play, again, is this a typical day in the market? No, it is not. And we still had a win early on, but that trade 2 ended up being a loser. It's fine. I didn't sweat it out. I didn't try to hope it comes back. It's like I hit my stop loss. I took my stop loss. I'll survive and I'll trade another day. And 2, 3, 4 trades later, I'm back in black. It's fine. So I get it. Like, it sucks to take losses, but it's part of the game when this thing is doing what it normally doesn't do. We usually don't see the market drift like this all freaking day. And now that it's higher, it's like, good. I hope it does this. I hope it gaps higher for us tomorrow. Okay, I hope it stays here, gaps higher tomorrow, opens up around 580, does nothing for the day, and we get our morning trade, and then later on it can do whatever the hell it wants. Okay, but I just want to see if there's a bit of a surprise to like the CPI news in the morning. Okay, all right. Anyway, any other questions? I think we're good. We can wrap it up here. I got to get on the road in about 10 minutes. Anything else? So Swiss pairs, I still like them. Dollar Swiss has been performing better since the dollar's been stronger the last week or so. Finally made a nice little breakout in the dollar. I'm holding dollar Swiss long all the way up towards like 92 or higher. I think the dollar Swiss can go higher, but this is where my pocket is. This is the biggest inefficiency I can find on the dollar Swiss. If I've got the courage to hold this thing, this is target 1, and this is a measured move that would be double that. And that finishes this pocket, and it gets right back into resistance. So target 1 is here. Target 2 is here. I would make a lot of money, and I will make a lot of money in this first target, because I was dollar cost averaging here, and on the break of this trend line, I was adding to positions. I was also getting back in, and I bought the double bottom. So if the dollar gets back to this level, I'm pretty much stacked in here with a lot of break evens or better, and this is plenty of profit. I'd like to hold on to it longer, but I don't need to. This is going to be thousands of pips of gains on the dollar Swiss because I've built this position. Okay. All right. So I still like dollar Swiss. I'm going to go ahead and mark this up on my chart. If we get back to this high, I think that's a good spot to be looking to take some profit right in there. And if I measure that move from the lows and project that higher, let's clone that. Oops. If we get a breakout there, then that pushes right up to these highs at 101. So, I mean, all my movements technically make sense. And I see this big inefficiency. I'd love to get it back into this area here. But for right now, if we just hold the lows and we work our way higher, that is a great spot for profit. So 9,200 is a great spot to profit. And the reason why is because I've been in this thing since this support level since 2023. And so if we get back to this high, there is not a single trade that I've taken that's going to be in a loss. Every trade that I've gotten into, from trend lines to retest the lows, to trend lines to retest the lows, all of them are going to be in profit. So I like that trade. I just want to see it get up to 92. So hopefully I'm patient enough to hang on to that trade until it does. Okay. That being said, everybody, right before the close, we're at 577.45. This like late push, late squeeze. It's a melt up type day. Markets are higher. NASDAQ up 0.84, SPY's up 0.75, Dow's up over 1%. Impressive that it's outpacing the other two. The Russell's up 0.25%. volatility. Interesting. Oh, this is VIX. Never mind. That's VIX at 5 minutes. Never mind. It's down in the day. VIX was up to $22. I mean, the VIX dropped all day. So the VIX is down, 5, almost 6% today. And this black line that you see on my chart, this is the previous all-time high. So if we get to 579, 580 tomorrow, or we pull back to this level and this becomes support, become resistance, do we find a way to still get to those gamma levels? It'd be much easier just to get there first, right? With this melt up here, we've had 2 days of strong gains. If we just get a blowout move because of CPI data, I'm looking to close out my SPY trade for profit, and then the rest of the day can do whatever it wants. The portfolio is going to look good. If it starts to fade from there, that's fine. As long as it's doing any major technical damage, it's just a day. It's just noise. Okay, so more to unpack tomorrow. All right, I'll let you go. Thanks for being with me today. If you're in the YouTube channel with me and you're not subscribed to the channel, please go ahead and do that. I'm live virtually every day for this final hour session, and live also with my 10:15 segment with A1 Trading, and then my daily profit play. We're live at 9 a.m. But I'm trying to offer as much content and consistency and continuity as I can. So I'd appreciate you subscribe to the channel, like all the videos, leave some comments. That certainly helps. And the old YouTube algorithm is supported, and all of a sudden my videos pop up on those searches.